From the morning reading, Brixet selling day 2. SPX, SPY finds buyers near Friday's support break price target. Futures gain after hours. 8 of 9 sectors moved lower on Monday. XLU, XLP, and XLV were the strongest sectors, while XLB was the weakest sector. Oil futures fell 96 cents to close at 46.61. Breath had 24.95 decliners versus 534 advancers on the New York Stock Exchange and 22.51 versus 379 on the NASDAQ. The winners were bonds, TLT at 2.5% increase, utilities, XLU at a 0.83% increase, and gold, GLD, at a 0.53% interest. The losers were stocks and volatility. VIX failed to confirm Monday's lower moves, suggesting that the sell-off may be near support. Monday's SPY dropped 33% from Friday's level, which looked like capitulation selling. Monday's volume showed less selling, which is a sign that stock is shifting from weak hands to strong hands. Futures are up in the after hours, another indication the selling may be waning and buyers returning, at least for a short-term bounce. Global stock sell-off continues. The British pound hits a new low. European stocks hit hard again. U.S. stock indices break May low. Dow and the S&P 500 fall below the 200-day moving average lines. Telecom, utilities, and REITs benefit from plunging bond yields. The global selling of stocks that started on Friday continued into the Monday session. Big losses in Europe signaled another bad day. The British pound fell to another 30-year low. The chart shows London's FTSE 100 losing more than 2% and falling below its 200-day average as well. The rest of Europe is doing even worse. The chart shows the Dow Jones Europe EX UK index down more than 4% and threatening its February low. The euro has fallen to the lowest level in 3 months. The dollar jumped again, which is putting downside pressure on most commodities and stocks tied to them. Gold, however, continues to attract safe haven money. The plunge in the 10-year Treasury yield to a 4-year low is supporting bonds, as well as dividend-paying stocks like telecom, utilities, and REITs. The plunge in bond yields continues to hurt bank stocks, which are leading U.S. stocks lower. U.S. stock indices are breaking support levels. The S&P 500 indeed fell below its 200-day moving average, which is when it has failed to hold above the long-term average after being above it for several months. It has tended to bounce back in the very short term, but then follow through to the downside in the weeks following. How the index acted over the next 2 weeks was a good predictor over how it acted over the next 6 months. Stocks suffered back-to-back severe selling days. The up volume ratio on both Friday and Monday was less than 15%, a fairly rare occurrence when stocks have been close to a multi-year high. The losses caused notable extremes in several indicators. Among them, the stock-bond ratio and the odd-lot short sales triggered readings that have typically been seen around panic conditions. Also worth noting is when stocks decline. Much of the selling pressure occurred on gap down opens, and it also bookended a weekend. Both kinds of activity have consistently led to short-term rebounds. Sentiment is scraping the bottom on country-specific ETFs. Monday's optimism index on the UK, France, and Italy are below 5 and have been for the past 2 days. For the UK, which is EWU, this has happened 14 other times, leading to a rebound over the next week 11 times, averaging 2.5%. For France, EWO, it might be EWQ, I'm not positive about that. It led to a rally over the next week 11 out of 11 times, averaging 4.3%. For Italy, EWI, there were 8 other times it had an optex below 5 on back-to-back days. A week later, it was higher 7 times, averaging 4.6%, with the sole loss being a negative 0.1%. So you wrap all this together, we're in the midst of a waterfall correction, and momentum could certainly carry prices down even further. In the short term, we could see a small bounce or consolidation so the market can catch its breath. However, when all the indicators in decline and bearish, I'd expect lower prices, even a drop to the August 2015 or winter 2016 lows, according to this author. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:14 a.m. Mountain Time, and I'm recording this in preparation for the market day of June 28, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, quite a bit of interesting material there from our various morning reading authors. You have this sentiment mentioned by a couple different authors that we might be due for a bit of a bounce or rebound. But then the final conclusion from another author that we're in this midst of this waterfall correction and momentum could certainly carry prices down even lower, expecting something of a bounce, and then ultimately, given all the indicators, a potential drop to even the August or winter 2016 lows. So quite a setup for today. Let's go ahead and go to the morning report. And indeed, we do seem to be in a bounce in the overnight Globex action. We'll see where that goes when the market participants join in, the cash market participants, in a little over an hour from now. At the time of this cut, the S&P futures were up about 20 points, or about 1%. Russell futures, NASDAQ, and Dow futures all up about 1 or just over 1%. Crude oil, big bounce, up 2.61%. The euro up about 2/3%. The bonds down about 1/4%, and gold down about 1%. Interesting that bonds is only down 1/4% when equities are up about 1%. That might be a little bit telling that this may be more of a bear flag and that this is just a relief bounce and then looking to leg down again. Bond traders are considered some of the smartest in the world, and they don't seem to be letting go of the bond price at this point. Of course, bonds are in inverse relationship with equities generally, not always, but generally, and bonds, we'll watch that. We'll watch volatility in some of these other markets to give us the tells as to what we think could be happening. And other markets overseas, China up about 0.5%, Hong Kong down about 1/4%, Japan up just over scratch, Germany up large, over 2%, and United Kingdom, big bounce, up about 2.5%, the time of this cut. In terms of U.S.-centered macroeconomic reports of note, you have the GDP, the final version for the Q over Q. And then you have consumer confidence coming in a little while later. Richmond Manufacturing Index, that's a minor report, but that'll be on the slate. And then looking forward towards tomorrow for the U.S., we have Core Price Index, personal spending, pending home sales, the weekly version of crude oil inventories, and the bank stress test results, which from what I've been reading, are expected to all be positive. And indeed, you have to give credit. The banks are in far better shape today to face any kind of market adversity than they were back in 2005. Let's go ahead and go to the current volatility conditions. We have short-term VIX is still very high at 25, though not as high as it was. Skew, kind of the same story, also high in warning category at 136, however, not as high as it was. In terms of IV percentiles, you see these are also still relatively high compared to what they've been, but coming down off the peak that they have had in the last couple days. Now, big picture here, let's put this in a bigger perspective. You know, the Russell's at a 52. Well, that's right there in the middle of the pack. So we've had quite a bit more volatility that has persisted in the last 12 months, but certainly this is well up over the volatility that we've had up until the recent sessions. Now you see the standard deviation moves here. There's some really ugly numbers and colors here, especially when you take into account the back-to-back days on the S&P, having a -1 standard deviation move the day after a -3 standard deviation move. You know, that's a pretty significant kind of action. Same thing over here with the NASDAQ. You know, you got a -4 and a -1. There's a lot of damage that's been done to those charts. In fact, let's go ahead and go to those charts. So we seem to be getting a bit of a bounce. Let's zero in the most recent range. We had, of course, this area of resistance up above us, which was rejected summarily, both in combination with the Brexit vote and other factors. But we quickly took out the May lows, busted down, but now we seem to be forming, at this point, using the S&P futures chart, something of a tweezer pattern. So we'll see just where this goes today, but it's up pretty sharply. That action seems to have started right when the futures opened and has been pretty much straight up ever since. And we are up some 20, we'll call it 81 to 2007, some 26 points right now, essentially straight up. So pretty interesting there. Now, as we come into these significant areas of resistance, you know, these former supports now turned resistance, we'll be quite interested to see just where this goes, especially as we come up into this area right here with the May lows. So look about 2022 area. Right now, we are playing in that 2007, so we got through the 2000 number. Let's see if they can get up through this 2022 area, or if that just becomes the end of a relief bounce. Remember, we dropped from 2120 all the way down to 1980. So what is that, 140 points in 2 sessions. That we would get something of a bounce is extremely expected. So the action that's important to watch isn't the bounce, it's what the bounce achieves and where does it peter out. Look for reversal candle patterns and the like. Watch your internals. If you're on an intraday trading basis, watch your market internals. Look for that breadth to roll over and start seeing some negative tick readings, especially -600s and so forth, and you'll start to see perhaps this relief bounce start to ebb. In terms of the other indices, they're all very similar together right now, and you see a similar tweezer pattern on the Dow futures. In terms of the NASDAQ, of course, has been the weakest, gave up the most, but also a very similar looking tweezer pattern coming in here at the bottom. And then finally, let's look at the Russell futures. A little bit different pattern here. It actually kind of gapped up. Russell, of course, has a little different set of hours and so forth. It's just a different animal altogether coming from that exchange that it trades on. And let's see what the VIX. Here's volatility. Volatility does seem to look at that classic reversal pattern there. Of course, you had the big move off the top of the wick there, and then you had a hammer pattern, and now this seems to be following through with the reversal confirmation. So volatility does seem to be coming down. The regular VIX showing very much the same kind of action. Of course, today's candle looks like they're marking it here at this time. We're at about an hour before the market opened. And then finally, let's go to some of the other markets of interest, such as bonds. This will help us understand. Now, we are getting a reversal here. Right now, it looks like a little bit of a dark cloud cover type of candle pattern. So a potential reversal setting up here. Though on a relative degree standpoint, bonds don't seem to be giving up anywhere near as much as equities are gaining. So that's a little bit of a potential contrary indicator. Also, gold, of course, has been the safe haven. It also seems to be doing something of a reversal pattern. And then we've had crude oil in a very high correlation of late. It also seems to be bouncing. So everything seems to be fitting in terms of setting up for a bounce and confirming that bounce, with bonds probably being the strongest signal of kind of a lack of belief into this bounce, at least as of this point. Remember, the markets have not yet opened, so we don't even have all the market participants playing as of yet. So that should be enough on the charts for today. Let's go ahead and go to the daily report. And we do have some important changes in the daily report. Remember, these are often incremental as you watch from day to day and you pick up what we call and look for as the change from the prior day, and then the rate of change. Now, not everything is equal, and some changes are more important than others, and certainly we have a couple of those in play for today. Now, we are in the market trend intermediate term phase opinion, phase 5, which is bearish. At the end short term is the descriptor, the break of horizontal and diagonal or support. We definitely have had that in the last couple trading sessions. But one of the most important changes is in our market timing signals, and two of our market timing signals, which are both mechanical, have deteriorated. In the IBD signal, it has gone to market in correction, its worst warning level, as it were. And then the GMI index has fallen to a 1 out of 6, and the GMI 2 to a 0 out of 8. This has converted to a sell signal as of yesterday's close, and that author is moving to cash. So 2 of the 3 mechanical market timing signals are now in a sell signal or correction signal posture. Now, the remaining market timing signal, it comes to us from the stock charts decision point scoreboards, and certainly we don't have a stack yet, but things are heading that way with the short term and all the setups in a neutral to bearish setup, and then the NASDAQ on the intermediate term has now converted to a neutral to bearish across both signals, the trend model and its PMO model signal. Now, the S&P and the Dow on the intermediate term are still holding up, and this, of course, is against the backdrop on all 4 of these of the mixed signals for the long term that's been in place for quite a while now. So when you put all this together, the consensus is decidedly bearish at this time, and you need to pay attention to that. In terms of position sizing opinions, buy long side portfolio exposure based on the portfolio investor model is now at 0%. The volatility based system, I left it at less than 50%. VIX technically was at a close yesterday of 23.85, I think it was. So technically it was just below this threshold. I went ahead for kind of a, in the spirit of conservatism, went ahead and rounded up to the 24, and I'm calling this less than 50%. So anyhow, bottom line, both position sizing models are calling for very, very conservative approaches at this time to long side exposure. In terms of the intermediate term market posture, further deterioration here as well. The S&P benchmark, our most important NDC, has fallen to strong bear signal, and this is also reinforced with a weak bearish sentiment line. And you see here below 50, 48.2, And so no new short-term or intermediate-term bullish trades would be the signal based on that mechanical signal. The Dow is still holding on just barely to weak bear, as is the Russell, again, just barely, but the NASDAQ also in strong bear. So decidedly, when you put all this together, it is bearish, and in some cases, strongly bearish. In terms of the hedge warning status, also a change here. We've moved from level 1+ to full out level 2, which is a red light. So this is our second highest hedge warning status, and your level of engagement into your risk activities, your understanding of what your exposure is, all those kinds of activities should be underway at this point. We've talked in detail about those kinds of things. We're already at 20 minutes, so I'm not going to go into the details today, but you should be activating those action steps that are associated with level 2. In terms of specific strategy opinions, option income, the VIX is not acceptable to initiate new positions for novice traders. We are outside the acceptable window. Expect, if you are an aggressive trader, to have to handle potentially large Vega and Delta moves, your adjustments, and the amount of cash that you would need to be able to make those adjustments could certainly be much more probable in size and impact. Covered call strategies, conditions not acceptable to initiate new positions for novice trader until the market stabilizes. Very aggressive traders might consider a 2-to-1 ratio of in the money and out of the money strikes, and a 2-to-1 ratio of low beta and high beta positions to the portfolio. If you're going to do something with a covered call, strongly consider legging in through selling of a put spread in the position size and scale that you're willing to own. In terms of specific warnings, you can see it's pretty much a sea of red. Just about everything that can be read is red. Market in decline. VIX spike fired with Friday signal, but it's not yet fired the vol crush signal. That could happen with today's action if we continue to follow through in the present course. In terms of VIX futures, still up over 18. Distribution days no longer counting because we're in the market in correction phase according to IBD. The skew is up over 135, which represents about 11% probability of a 2 standard deviation move in the next 30 days. Current 10-day out up over 60, so very elevated. All of our trend signals are in extreme or warning status. Look at the New York Stock Exchange yesterday, only 96 new highs for the month versus 1,205 new lows. The intermarket risk aversion indicators all strongly in the risk off position. Sentiment has scrubbed off with this. We are due for a bounce, so keep that in mind. Bonds and gold are pretty high sentiment, so watch for reversal signals there as well. From the CNN Money Fear and Greed Index, you see down to a 37. So just a few days ago, we were up in the extreme greed, now all the way down to a 37 on the sentiment. Also in the sector specific, it's pretty much a sea of red at this point, with only utilities holding up across all 3 time frames. And indeed, you see, look at the 1 day, even the 5 day. In the face of this, it is utilities and telecom, followed by consumer staples, that have been holding up the best in the face of this market onslaught. So those are all 3 very much expected and very much talked about here on this morning market preview of late. If you follow us in the trade room, you know that our core portfolios are very heavily centered in these areas right now, and that has certainly helped us in many, many ways with our portfolio at this time. And I think that's enough for today. Let's go ahead and roll through the closing sequence to the disclosures. Again, a long session given all the information that's come available with this market meltdown. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note at the bottom the full set of disclosures. We'll see you back here for tomorrow's market preview from Falcon Global. In the meantime, manage your risk and good trading.